What's going on, guys? Trading for Dummies episode 7. We've got order blocks. Really simple, in my opinion. Um, so you're in a downtrend. So you got liquidity resting over here. And you've swept that liquidity, and we've pushed higher. The move that swept out this liquidity is our order block. So all of this area here, that down move that took the liquidity then pushed higher. That is our order block because that is the range where the large institutions got their orders filled. Now, the rectangle. If we remember from liquidity, the market movers seek out liquidity to get their orders filled to move price where they want it to go. Now, once liquidity has been taken, they start filling their large orders. So say their liquidity was taken, they get large buy orders filled to move it higher. So the price range, hang on, let me go back a little bit. So they swept out the sell side liquidity because of lots of sell orders at this point because the lows pushed past. Like, say there's a low over here. This low's pushed past, so people will fill their sell orders, and people that are long in get stopped out because it's below the low. So banks can then fill large buy orders and then move it higher, which you can see happens with this line chart, perfectly drawn out. So this price range is where banks filled their large buy orders, and then say they've got some selling pressure. Banks can send it back into this price range because they knew they got their orders filled there, so they want to push it lower to get even more orders filled to then move it higher. Or price just wants to seek out this area so banks can fill orders and go higher. Quite simple. Uptrend now. We're in an uptrend. We sweep out highs over here. Let's, for example, lots of people's buy orders get filled because people shorting get stopped out. People longing because the highs push past into their longs. Lots of buy orders here getting filled. Banks can use this to fill their large sell orders because it's a transaction. Remember, it's an exchange. So they want to fill their large sell orders. This price range here, this large leg up to sweep out the liquidity, is our order block. Banks can send price back into this area to get more sell orders filled to move it lower, or price can just go into there because it's an area, and then they move lower. Quite simple. That's an order block. It's the price range that sweeps the liquidity where banks got their orders filled. Now, putting this onto the chart. Perfect example right here. We've got untouched lows here and liquidity there. This black candle is the move that sweeps out the liquidity, the move down. There's our order block. We can see we come right in perfectly, hit the order block, boom, go higher. We are in an uptrend right now, so this is quite tricky to find actual ones recently. We'll have to go back. I can't really find any right now. Just gonna find one example, but I can't find an example. I guess you can call this one. We had highs here. We came up, we swept out those highs. What's our move up that caused that sweep? This price range, the blue candles that swept it out. There's our order block. We come down, we come in, go lower, come in again, come lower. Banks got their orders filled in this price range. You can see we tap into it, zoom, down. I don't use order blocks that often in my trade recaps. But on Wednesday, I think I used one quite well. We can have a look. Go to Wednesday at 2:30. There's market open. So we had these 1 minute highs getting swept. What's the move that swept it? This move up, we'll go with the last blue candle. There was this one that I used it as. We come into the order block, we fill it, we go lower. I used this as a confluence on that trading day, I remember. You could call the order block that entire move up. There, as that's the entire move that swept up liquidity. Either way, we come in, we fill it, we go lower. Order blocks for me, they're quite useful if there's no imbalances. That's only really when I turn to use them. But quite simply, this diagram helps me a lot. It's that price range, the move that sweeps out the liquidity, and it's that price range, the move that sweeps out the liquidity. So recap, the order block is that move, the move down or the move up that sweeps out liquidity, and it's the price range where banks got their large orders filled, and price can go back into there. Banks can fill more orders and send it lower, or go back down into there, fill more orders and send it higher. It's a key area, a key confluence where price could retrace to look for entries. Again, we want to use this together with a liquidity sweep, a break of structure, an order block, and then an entry on the lower time frame. Typically, there's only one order block because some people mark out order blocks as every retracement, but typically for me, an order block only happens when there's a liquidity sweep. So there's only one order block per trend down or trend up. But this is a perfect summary, and I have had this drew out in my notebook ever since I learned them, and it really just helps me. The order block, a bullish order block is the move down that sweeps out liquidity to move it higher. A bearish order block is a move up that sweeps liquidity to move it lower. And it's a price range where banks got their large orders filled. That is all I have to say for order blocks. I hope this video helped. If you don't get it, watch someone else. If you do get it, go on the chart, look at it. If you don't get it, go on the chart, whatever. Leave comments on how I can improve. Same old, same old. Hope you guys enjoyed. See you in the next one.